A wonderful day to you all. Welcome to Nifty Sense. Before we dive into the gears and levers of today's market, let me ask you a question that might seem unrelated to your portfolio. If a neighbor you don't even talk to starts an argument over a fence 3 streets away, why does your landlord suddenly want to raise your rent? That is the hidden narrative of January 20th, 2026. Today, the Indian markets didn't fall because of what happened in Mumbai or Delhi. They fell because of a landlord across the ocean and a frozen island called Greenland. The Daily Ledger. Closing figures. January 20th, 2026. Nifty 50 to 25,232.50, down by 353 PTS, 1.38%. Sensex, 82,180.47, down by 1,065.71 PTS, 1.28%. India VIX, 12.73, up by 7.63%. The fear gauge is heating up. Sectoral pulse. Top 3 gaining sectors. Metals, select non-ferrous, showing resilience as a commodity hedge. Public sector banks, led by SBI, acting as a defensive shield. Hospitals/healthcare, Dr. Reddy's, held flat, while others bled. Top 3 losing sectors. Realty, filled down pointing triangle 5.04%, the hardest hit. Imagine a skyscraper losing 5 floors in a day. IT services, filled down pointing triangle 2.10%. LTI Mindtree and Wipro leading the retreat. Consumer discretionaries, high-end brands like Trent showing cracks. Institutional flows, FII net activity, 2,938.30 crore rupees. The big tenants are moving out. DII net activity, plus 3,665.70 crore rupees. The local landlords are buying the dip. The market breakdown. The Greenland Paradox. Why did the market move? To understand today, you must understand tariffs. Imagine you have a lemonade stand. Usually, you buy lemons from a friend for 10 rupees. Suddenly, the local bully says, if you want to sell lemonade on this street, you have to pay me an extra 5 rupees for every lemon you buy from that specific friend. That extra 5 rupees is a tariff. It makes your lemonade more expensive, people buy less, and your profit disappears. Today's cause and effect. The geopolitical spark. U.S. President Trump threatened a 10% to 25% tariff on 8 European nations over a dispute regarding Greenland. The chain reaction. Europe is India's massive lemonade customer. If Europe's economy gets hit by U.S. tariffs, they buy fewer IT services from Bengaluru and fewer car parts from Pune. The result? Investors got insurance fever. When the world looks risky, big investors, FIIs, sell stocks, risky, and buy gold or dollars, safe. This is why the rupee hit a record low of 90.97 today. Green flag deep dive, institutional footprints. Even in a storm, some ships have reinforced hulls. Today, 2 names stood out with relative strength. 1. HDFC Bank, the fortress play. While the Nifty crashed 353 points, HDFC Bank was one of the only green spots in the Sensex. The value moat. Think of HDFC Bank as the utility company of the stock market. Just as people will pay their electricity bills even during a recession, businesses and individuals in India are tied to HDFC's massive credit ecosystem. Institutional activity. DIIs, domestic funds, were seen aggressively accumulating here. When the big money buys while the world is selling, it's a sign they believe the price is in an accumulation zone. They aren't looking at tomorrow. They are looking at the next 5 years. 2. Jindal saw the infrastructure pipe moat. Jindal saw surged 3.74% against a bleeding market. The value moat, they reported a 69.85% jump in net profit QOQ. Their moat is their order book. They make the pipes that move India's water and energy. The analogy, if the stock market is a city under construction, Jindal Saw provides the plumbing. You can stop buying new clothes, retail/Trent, but you cannot stop building water lines. This is a structural strength play. The dark horse. The silent accumulation. The sector, non-ferrous metals and mining, specifically zinc and aluminum. While the headline screamed bloodbath, the metals sector showed a quiet, stubborn refusal to stay down. Hindustan Zinc reported a 46% YoY profit jump today. Deep dive, the dark horse, the silver-lined metal shield. While the Nifty was shedding 350 points, the metals and mining sector, specifically non-ferrous players, behaved like a dark horse. It didn't just survive. It galloped in the opposite direction of the index. To understand why, we have to look at the unique institutional footprint currently forming around companies like Hindustan Zinc, HZL. The mystery of the silver wave. Today, Hindustan Zinc hit a 52-week high of 673 rupees and 75 paise, gaining nearly 1.5% to 4% across different trading windows, while the broader market was in a tailspin. The hidden narrative. Most people think of zinc as a boring industrial metal used to coat iron to prevent rust, galvanization. But the hidden narrative today is silver. The moat, HZL, isn't just a zinc company. It is one of the top 5 silver producers in the world. Today, as geopolitical tensions over Greenland and U.S. tariffs spiked, global investors flooded into safe havens. The result? Gold and silver prices hit all-time highs. Silver surged past $95 per ounce. For HZL, silver now contributes a staggering 44% of its total profit. Professional analogy. Imagine you own a shop that sells basic umbrellas. Zinc. Suddenly, a massive storm hits. Not only are you selling umbrellas, but you also happen to own the only factory in town that makes high-end waterproof luxury coats, silver, that everyone is desperate to buy as insurance. Even if the rest of the mall is empty, your shop is packed. The conclusion for the dark horse. The dark horse isn't the fastest runner. It's the one you didn't see coming because you were distracted by the favorites. While the world watches the big 4 inches IT stocks tumble due to Trump's tariffs, the smart money is moving into hard assets. The logic. In a high-inflation, high-tariff world, paper money, currency, loses value. But hard assets, metal, keep it. Institutional investors are quietly shifting weight here. It's like moving your savings from a wallet that has a hole in it to a solid silver box. The box itself is the wealth. The Sentinel Insight, understanding the safety valve. To truly grasp why certain stocks survived today's 10 lakh crore wipeout, we need to look at the market VIX and the flight to quality. Imagine you are at a crowded summer festival. Suddenly, dark clouds roll in and a heavy downpour begins. Most people run for the exits. This is the market sell-off. However, a few people stay exactly where they are because they are standing under a massive, permanent concrete gazebo. They get a little damp, but they aren't soaked, and they aren't panicking. The VIX, our panic meter. Today, the India VIX volatility index jumped by 7.63% to 12.73. In simple terms, the VIX is like a thermometer for the market's fever. When it's low, everyone is calm. When it spikes, it means investors are buying portfolio insurance options because they expect the ground to shake. Why quality acted as the gazebo? When the VIX spikes, the institutional footprint shifts. Professionals stop looking for growth at any price and start looking for cash flow at a fair price. Dr. Reddy's plus 0.46% and HDFC Bank plus 0.28% weren't green because they had exciting news. They were green because they are the concrete gazebos of the Nifty. Investors know that even if US-Europe tariffs cause a global slowdown, people will still buy medicine, pharma, and people will still need to process transactions, banking. The safety valve lesson. Today taught us about correlation. When the big tenants, FIIs, pull out 2,900 crore rupees, they don't sell just the bad stocks, they sell the index. This creates a relative strength opportunity. The pro tip. Watch the stocks that fall less than the index during a crash. If Nifty falls 1.4% and your stock falls only 0.2% or stays flat, you've found a company with a high institutional moat. These are the stocks that often lead the charge when the sun comes back out. Today's lesson is about correlation. In a globalized world, a bully in the Atlantic affects the lemonade stand in Mumbai. Senior strategists thought wealth is not preserved by jumping out of the window when it rains. It's preserved by owning the roof. Today was a day to identify which companies are the roof, utilities, banks, infrastructure, and which are the windows, high-growth IT, luxury retail. In times of institutional crossovers, where FIIs leave and DIIs enter, focus on the institutional footprint. Follow